Schmitt Capital would like to introduce its proprietary credit enhancement and bonding program. This program will introduce both internal and external credit enhancements for real estate development projects. Who does this program benefit? First, developers who are finding it hard to capitalize deals because of traditional financing. Secondly, the lending institutions. Banks are looking to reduce their financial exposure by increasing their equity requirement and reducing the loan to cost. Lastly, and most importantly, the insurance company. By lending the credit enhancement for a fee, Schmitt Capital's program will drive cash to the insurance company throughout the life of the project at a reduced risk. The project on the left is traditional, and on the right is the Schmitt Capital's enhancement program. Both have the same total cost and end market value. This shaded space is developer equity. The land is always an underlying asset that cannot have a value of zero. In our example of a $100 million project, the total project cost is comprised of three components: land, hard cost, and soft cost. The total of these three components will always be 70 to 75% of the completed market value. All of these items serve as collateral throughout the life of the project and policy. The completed market value is calculated by the current market rents minus the expected expenses equals the net operating income. Then we divide the net operating income by our applied cap rate to achieve market value. Another factor that boosts market value is land appreciation. The profit margin, also known as the holdback, can also be referred to as the deductible. Schmitt's underwriting procedures have a profit minimum threshold of 2 times equity multiple on the developer's equity. This will further reduce the risk. So why would a developer consider using Schmitt Capital's product? Because of how Schmitt Capital structures projects, the developer's equity requirements are far less, 20 to 25%. However, traditional structures require 35 to 45% equity plus 18 to 24 months of reserves. Schmitt Capital will act as servicers in addition to the bank's third-party inspectors. Schmitt Capital services the project at all stages: foundation, structure, mechanicals, and finishes, therefore creating the value for parties involved. Today, insurance companies typically participate in a current real estate development project by providing the following policies, in which the developer pays 1 to 2% of cost. Schmitt Capital's program aims to involve the insurance company by utilizing credit enhancements such as cash collateral, developer's equity, credit wraps, project-specific insurance wrap-up, holdover deductible, line of credit, financial guarantees, and put options on purchase. Let's review the internal credit enhancement. The first tranche is the cash collateral used to absorb any losses. Second is the developer's equity. Third is the mezzanine piece that has the credit wrap. Fourth is the senior note. And fifth is the holdback deductible on the stabilized market value. Let's talk about risk aversion. Tranches get structured as follows. Cash collateral is posted to absorb any losses. Second, developer's equity. Third, once the developer's equity is completely absorbed, Schmitt Capital assumes the entire project and the value of the land. Fourth is the senior note, which the originator is foreclosure remote. Last, the holdover deductible. Essentially, we are acquiring the project at 65 cents on the dollar comparative to total cost. The credit wrap placed on the $15 million mezzanine loan is offered at a 12% yield to the developer. It represents 15% of the project cost. At 12%, the coupon generates $1.8 million annually in interest. We securitize the debt and sell this credit-wrapped A-rated bond on the secondary market for a 5% yield or less. This net excess cash of $1,050,000 is placed in a reserve which serves as an internal credit enhancement. This spread will become income for Schmitt Capital and the insurance company upon completion. The external credit enhancement, like insurance wraps, financial guarantees, letters of credit, and the put option, all have a symbiotic relation. The insurance wrap placed on the project will limit risk exposure and bundle all parties involved under one insurance policy, also known as a wrap-up or project-specific insurance. Banks and developers prefer this method on projects because it reduces costs and overages. The financial guarantees provided by the insurance company will come with a greatly reduced risk since they are the third party to take control of the project. As a result, the originator is foreclosure remote. In turn, banks are confident in issuing a letter of credit. This letter of credit is controlled by Schmitt Capital and will be drawn upon to ensure the completion of the project. Schmitt Capital servicers and the bank's third-party inspectors will ensure funds are not dispersed unless construction hurdles are met. The final enhancement brings the last piece of the puzzle. Schmitt Capital negotiates a predetermined put option on the end buyer in today's market. Schmitt Capital's program can be applied to existing distressed assets and owners in good standing who are having difficulty restructuring debt. It can easily be expanded to meet equity requirements domestically and globally.